All right, ladies and gentlemen, welcome to the World Politics Show. Started off with a little sampling from my favorite rock and roll song, Love Shack. Love Shack. Got love going out to all you guys. All right, so today I'm going to share with you a lecture on the 2008 financial crisis. One reason why I chose to spend time on this in a class on world politics is because it is really a global financial crisis. So it helps us understand something about how interlinked and interdependent the national financial systems are to one another, and how financial problems or contagions can move from one region of the world to another. But another reason is because the 2008 financial crisis really revealed a lot about some of the weaknesses and vulnerabilities in the global financial system, and we still, we still have those problems. And in fact, I would tell students up until this semester that pay attention because something like this could happen again. Well, guess what? We are now entering into a major economic downturn, which has very different causes from the 2008 crisis. But nonetheless, we will see that some of the same vulnerabilities are in play here. In the 2-week period up to last Thursday, we had 10 million first-time unemployment claims. The previous record for 1 week was around 700,000. So 700,000 1 week, 10 million 2 weeks. You can see that we've already shot up to about 13% unemployment, and it'll probably rise considerably above that. So we're in for a bit of a tough time. One of the question marks that we'll pay attention to is whether in fact this downturn does trigger financial problems, and particularly if credit freezes up as uncertainty about which sectors of the economy are going to come back and how long it'll take them, which firms are going to go bankrupt, how much support the government will provide. All those questions create uncertainty, and uncertainty can encourage bankers to quit lending. It can also encourage borrowers to take out their money. So yeah, we have we're facing some big challenges ahead. Hopefully, this crisis will pass relatively quickly, which might allow us to get back to something resembling normal more quickly as well. But let's go back and look historically at the 2008 financial crisis, which was the biggest, most consequential economic downturn for the United States since the Great Depression of the 1930s. There are, typically in a capitalist economy, there are periodic booms and busts, but this one was out of the ordinary. So let's look at, for instance, the GDP growth. You'll see this this chart shows us that the U.S. economy was in positive territory going into through 2007, and then look at the downturn in I guess it was the final quarter of 2008, 9% drop in gross domestic product, which is a measure of the overall size of the economy. So we had a period of roughly roughly 2 years when the economy was underwater, and then you'll see a recovery. Although usually coming out of a severe downturn, we would get growth rates of 4 or 5%, and you'll see we were on the lower end of that range coming out of the 2008 crisis. Here's another indicator to give you a sense of how serious the crisis was. This shows the drop in employment and the ratio of employment to population. So prior to the crisis, about 63% or so, 62%, 63% of Americans of working age were in the labor force, and that fell to down around 58, 59% in very short order. Look at the stock market. This is the Dow Jones average. You can see that it was trending upward during the first 7 years of this century, and then big downturn. House prices. Notice that home prices were rising from during the 90s and the early 2000s, reached a peak around 2006, and then look at this huge drop-off overnight in 2007 and going into 2008. Prices just tumbled. So how did this all happen? Well, first of all, let's notice what was going on in the global economy. One thing is that there had been a prior economic crisis about a decade earlier. We noticed that 1998, 2008, now 2020, about every 10 years we seem to have some kind of crisis. So in 1998, the crisis started in Asia, and there were runs on the currency. Currency traders were selling off Thai currency, Korean currency, Hong Kong currency, Indonesian currency. They were all being sold in the marketplace, which tended to force their prices down. Governments tried to defend the value of their currency because that a falling currency value can harm the standard of living of their people. In fact, it makes it very expensive to buy foreign goods if your currency is weak. So they stepped in. They used what are called foreign currency reserves, their stashes of mainly dollars, to try to defend the currency, but they didn't have enough reserves, and so the currency fell, and their economies went into a sharp downturn for a period. Now, one of the lessons that countries in Asia learned, therefore, was we need bigger reserves. So they began crafting their economic policies precisely to export more and import less so that they would run trade surpluses. And when they ran trade surpluses, they accumulated more and more US dollars and held those in reserve. So if there was another run on their currency, another case where speculators were trying to push the currency value down, they would have enough reserves to defend their currency. They could as traders were trying to sell their currency, they could buy with the dollars that they had on hand and hold up the value. So there were that meant that as these reserves grew, there were the growing number of dollars being held by foreign governments. You can see that one consequence was a growing imbalances in trade flows. So especially the United States is the on the bottom there. It's kind of the, I don't know what that is, turquoise maybe, or teal or something. It's kind of a lightish blue color, blue-green. Below the red line, you notice that almost all of it's that bluish green color. Well, that's all U.S. running trade deficits. And above the red line are the countries that were running surpluses. For every deficit in trade, there's a surplus for another country. It always has to balance out to zero. So as especially Asian countries, but also European, Middle Eastern countries ran larger trade surpluses, the U.S. was pushed into a larger deficit. You can see with China alone, the U.S. exported, this was, I don't see the year here, I think it was probably around the year 2000. The U.S. exported $81 billion a year to China, but we imported $344 billion. Well, that means that when we're buying Chinese goods, we're sending dollars to China. And they use some of those dollars, namely about 81 billion, to buy our goods, but whatever's left over, 344 minus 81, that's how much dollars that China is holding in its own reserves. Now, those reserves that China is holding, they're not using those to buy our goods, so what are they doing with those? Well, they want to make some profit on those reserves, so they actually use them to invest in the United States. Now, they could invest in buying real estate, which does happen. They could invest in stocks and bonds, private stocks and bonds. A lot of it went into, in fact, most of it went into buying US Treasury bills. Treasury bills were considered the safest investment because unlike private bonds or stocks, they're backed by, the Treasury bills are backed by the US government. We issue Treasury bills in order to raise money to cover our budget deficits. So in a sense, China was helping the US cover its budget deficits by buying up Treasury bills and using dollars that they earned by selling to us to do so. So China was one example, but the other countries that are running surpluses, Germany, Saudi Arabia, they're also doing the same thing, buying Treasury bills. So let's start from there and figure out how does that lead to a financial crisis. Well, as I said, you have this flood of dollars coming into the U.S. economy. As we run trade deficits, we're running a surplus on the investment account, which of the balance of payments, meaning that more dollars are coming in than going out. So all these dollars are coming into the U.S. economy, and one reason is because the other countries run very high savings rates, and we have a very low savings rate, and that combination produces these trade imbalances. Now, then we have 9/11. So the attack on the Twin Towers, on the Pentagon, in the United States, set off a period of uncertainty, and it temporarily led to a downturn in the U.S. economy. So in order to stimulate growth, to get people spending again during this period of uncertainty, the Federal Reserve, which controls the U.S. money supply, it lowered interest rates in order to try to get people to buy homes, cars, washing machines, and that would lead to economic growth. So the Federal Reserve is pushing down interest rates. Money from overseas is coming into the U.S. economy. Well, when interest rates are so low, if you factor in inflation, the Chinese were looking at this and saying, you know what? We're actually losing money on the money that we're putting into U.S. Treasury bills. We're actually, after we get a very low interest rate, maybe 1%, and then if inflation is 2%, then we're actually losing money by investing in Treasury bills. So they're safe, but they're a lousy way to make money. So they said, they start looking around, the Saudis, the Germans, they look around, they say, hey, what else could we buy that's relatively safe, but that would return a much higher interest rate? Well, they looked to was mortgages. And they said, look, homeowners, mortgages that they are putting in or 3, 4, 5% um, interest payments on their mortgage. That's even at 3%. That's like triple what we're getting on our treasury bills. It'd be great if we could somehow get into that market. If we could be involved in, get the interest on uh, by putting our money into mortgages. Well, the problem is that the Chinese had no ability to go around and issue mortgages to millions of Americans, right? So how are they going to take advantage of those higher interest rates? Well, the banks saw an opportunity. There was a lot of foreign money coming in. The investors wanted higher interest rates. They weren't getting them through treasury bills. So they said, the banks stepped in and said, hey, what we can do is we'll go and buy up all these mortgages. We'll combine thousands of mortgages into what we called collateralized debt obligations, which means that these mortgages are all bundled together and then sold. You sell off pieces of these, what are called CDOs, to investors that are looking for better returns. So the investors who have all this money, all these dollars, they say, great, we will buy these collateralized debt obligations, and that will mean that all these principal and interest payments coming in from mortgage holders every month will come into our account, and we'll be able to make money off of that. So the banks are essentially putting themselves between the mortgage buyer, the homeowners, and the ultimate owner of the mortgage, which is now being sold off to an investor. Now, this led to a housing boom because in the past, what happened is that a local bank or a mortgage broker would issue a mortgage in their own community, and it would be a 30-year fixed rate mortgage most of the time. And they would hold on to that mortgage, and every month they get a little payment and they make a little profit over a long period of time. And they would make enough of these to be able to, make their business profitable. Now, all of a sudden, big banks are coming in and saying, hey, we would like to buy those mortgages off you. And the mortgage brokers or the local banks say, all right, we'll sell them to you. We'll make a little profit on that sale. We also make a little profit when we charge a fee to the homeowner to issue a mortgage in the first place. So we're going to not make money by waiting till the homeowner pays their mortgages and live off the interest. Instead, we're going to issue as many mortgages as we can. We'll make a small fee every mortgage. We'll make a little more profit when we sell it to the bank. And the more mortgages we issue, the more money we make. Moreover, when the local banks held mortgages, that was always a risk, right? What if a homeowner doesn't pay on their mortgage if they go bankrupt or whatever, and then the bank has to foreclose and they lose money. Now the risk is being, passed along to these big banks, and the risk is embodied in these collateralized debt obligations. So there's no real risk for the local banks or the mortgage brokers. They're making money off fees. So their incentive is to close as many mortgages as possible. Now, in the past, if they were holding on to the mortgage, it meant that, hey, I want to make sure that this homeowner can actually pay, has a good credit risk, that they can actually make payments for 30 years on this mortgage, and that would be a way of reducing our risk that the mortgage will go bad. Well, now, as I said, they don't worry about risk anymore. So instead, what they do is they lower their lending standards. So, for instance, they might not even require you to. They might not even call in to check to see if the job that you claim to hold is one that you actually employed at. They might accept a lower credit rating, right? They might. Um, well, for instance, they did things like, let's say, an accountant. The range for a junior accountant is the income is usually $40,000 to $70,000 a year. Well, you tell them that you're a junior accountant. Maybe you're at the 40. You actually make 40,000, but they're going to put you in at the highest level, the 70,000. They just pick the highest in the range for that job category, even though that's not the actual money you're making. That allows you to take out a bigger mortgage. They were also doing things like issuing mortgages with no money down. So traditionally, you put 20% toward the price of the home up front, and you would take out a mortgage for the rest. Here, you're not putting any money up front. You're just taking out 100% loan for the home. Or, for instance, you would take out a balloon payment mortgage, and that's where you start off and you pay only the principal for the first 3 years or 4 years or 5 years, and then all of the interest that you've not been paying during that period is charged in one big lump sum at the 3-year mark or at the 4 or 5 year mark of your loan. So you have low payments to start out with, but then you have this big balloon payment, as they call it, down the road. They were doing mortgages like that, which again that's not a good way to handle risk. Now, what about homeowners? Well, all of a sudden they can buy a house, low interest rates, no money down, with a low credit score, right? Easy terms. They are ecstatic. They start buying up homes, or maybe they wouldn't have bought a home. Now they're going to buy one, or they would have bought a home, but they would have bought a modest home. Now they're going to buy a big jumbo home, a mini mansion. So home sales skyrocket. A lot of these are what's called subprime mortgages. Those subprime mean they're risky mortgages, that they don't carry the normal standards, the normal down payment, the normal credit standards that signal reduced risk. Well, of course, if everybody's buying homes, that's pushing the price of the home up. So you saw the rising value of rising home prices in the first 7 years, or actually through the 90s into the early 2000s. So homes are getting more and more expensive. So people are buying homes that they really can't afford. So how do they think this is going to work? What'll happen down the road when they have a balloon payment, or if they find they can't, they buy a home that they can't afford. Well, the way that people thought is that, well, home prices are always going to go up. More local banks seem eager to refinance mortgages. So what we'll do is we'll take out a home. We'll take out a mortgage on a home. It's more than we can afford, but we'll take out a balloon payment. And then when the balloon payment comes along, we'll refinance the mortgage, because now instead of being a $150,000 home, it's a $250,000 home. We have $100,000 in equity just from the increased price of the home. So we'll borrow that $100,000. We'll use it to pay the balloon payment, and we'll keep the rest and go out and have a nice European vacation, right? And they said, well, what happens later on when they still can't pay the now they have even a bigger mortgage, right? They have a $250,000 mortgage. Well, they figure that in a few years the price will be that much higher. They'll take out another refinance loan, and they'll be able to keep doing that. Um, uh, but in fact, if you think about it, eventually it catches up with you, because what if the price of the home doesn't go up, and what if you can't refinance? Then you're in trouble. Now, the risks that were built into this system um, were supposed to be caught by credit rating agencies. There are three of them: Moody, Fitch, Standard and Poor. What they do is they would take a credit default obligation, a CDO, and they would look at the mortgages that made up that CDO, and they would evaluate. They would break them into so-called tranches. And they'd say, these mortgages, this 10% of the overall mortgages in the CDO are primo. They're the highest rated. The next 20% are a little bit lower rated. And they'd go down and they sort of rate the different types of mortgages by risk, and then they would come up with a rating for the CDO as a whole. Now, one thing to know about these credit rating agencies is, how do they make money? Who actually pays for these ratings? It's actually the big banks, or any other anybody else that's issuing bonds, for instance, corporate bonds. The issuer of the bonds, or the CDOs in this case, is the same entity that is paying the rating agency to issue the rating. Now, right away, you can see a conflict of interest there, right? That you want a good grade, you want a high rating on your CDO. If you go to Moody's and they give you a disappointing rating, you're not going to go back to Moody's. You're going to go to Fitch next time, and Fitch will get your money, your payment for giving the rating. So you have these rating agencies competing with each other to do ratings. And how do you get more business? You get more business by giving high ratings, even if they're in fact the CDO is very risky. So investors were looking at the ratings on these CDOs, and they were saying, this looks pretty low risk, got a nice interest rate, we'll invest in that, we'll buy that. Of course, they're not able personally to go into the neighborhoods where these loans are being, where these the homes are located, and evaluating whether the homeowners could actually make those payments or not, whether the home's worth what it's priced at or not. So they're relying on the credit rating agencies, and they're getting, for the most part, bad information. Nevertheless, the investors, these are sophisticated, wealthy people, governments, pension funds, hedge funds, mutual funds. And so they're not dumb. So they say, okay, we recognize there must be some risk associated with these buying a CDO or a piece of a CDO. So we're going to need some way to reduce our exposure here. Well, where a company called AIG, American Insurance Group, steps in. AIG says, okay, you've got all this money going into CDOs, but the investors are nervous about the risk. What we'll do is issue what are called credit default swaps, or CDS, which are basically insurance policies on the CDO. And basically, we'll tell an investor, you buy one of our CDSs, and you buy one of these insurance policies, and it says that if the CDO goes bad, if a lot of these mortgages fail, and all of a sudden that income stream from the CDO dries up, guess what? We'll make up your losses. So give us a fee up front. We'll and then if you run into trouble later, you are insured. Well, that sounds like normal insurance, except for one thing. Normally, insurance companies have collateral to back up their policies. So if they issue a policy, has some risk that they have to pay out, they have a financial reserve on hand to cover that, um, uh, so that they're able to make those payments. AIG didn't have any collateral backing up these credit default swaps. The insurance policies were totally exposed. Their reasoning was that surely these CDOs are not going to all go bad at the same time, and this is very low risk. We're just taking in these insurance fees and making huge money for doing nothing, basically. And so they didn't bother to have any collateral. Since they weren't a bank, they're not officially a U.S. insurance company because the office is located in London. Then neither U.S. banking nor insurance regulators were able to force them to have collateral. So they're totally exposed. So what happens? Should have been predictable, but relatively few people did. The film called The Big Short looks at some guys who figured out, in fact, that this was all going to come tumbling down, and they bet that it was in the marketplace, and they made a lot of money that way. So the housing market implodes. Sure enough, the prices keep going up. People are taking out riskier and riskier mortgages, and balloon payments are coming due, and people are defaulting on their mortgage, and that forces the banks to foreclose on the homes. Prices for homes start to fall. In fact, as we saw, they just the bottom, they just collapsed basically. And there are a lot of homeowners who basically owed more on their home than it was worth. In other words, if they sold their home, they would not even make enough money to pay off the mortgage. So if their mortgage is $150,000 and they sell the home for $100,000, they still owe $50,000 even though they don't have the home anymore. So a lot of people said, that makes no sense. I'm not going to sit here making payments on a $150,000 mortgage when the home's only worth $100,000 now. So they would literally drop off the key and take off and just leave the home, turn it over back over to the bank, walk away from their mortgages. Now the banks, of course, seeing all of this go on, they stopped lending, and that when they stopped lending, then the housing market, it crashed even further. All of a sudden, there's this glut of repossessed homes that the bank are now given back to the banks, or the banks have foreclosed, and no one is buying. So the banks are sitting on all these homes. What's a little bit interesting is that the banks had so many foreclosures, they had no capacity to actually process all of these foreclosures. To foreclose, you actually have to go to a judge and do a legal proceeding to get people to force out the homeowner if they're not making their payments. They had no ability to process so many millions of foreclosures at the same time. So some people were able to stay in their home 2 or 3 years even, until the bank finally got around to foreclosing. They're not making payments, but they're still there in the home. And when they did try to foreclose, remember we said that the original local bank or the mortgage broker would make the mortgage, but then they'd sell it on to a big bank, who would then put it into a CDO, who would then sell the CDO to an investor, and the investor might sell the CDO to other investors in what's called the secondary market. And actually the mortgage would change hands multiple times. And so homeowners, the bank would take a homeowner to a judge and say, Judge, this homeowner's not making the payments. We would like to foreclose on the home. And the homeowner would say, that's fine, please, but please prove that you are in fact, the owner of the mortgage. Prove that you're the one that I owe money to, right? And the paperwork would in fact be 3 or 4 steps back. That a lot of times the paperwork that would prove that the investor actually owned the mortgage would not keep up, and so they wouldn't actually have the paperwork, and the judge wouldn't be able to foreclose on the loan. Actually, kind of humorous, I think, but so all of a sudden the CDOs start failing, and investors are freaking out, losing money, but they're saying, okay, we're okay, because guess what? We took out an insurance policy, a credit default swap with AIG. So they get AIG and they say, the CDOs we invested in are no good. They're failing. Mortgage owners aren't paying. We're losing money, so we'd like you to honor your insurance policy and cover our losses. And AIG says, sorry about that, but we don't have any collateral, and so there's no way we could possibly honor these credit default swaps. So then credit starts freezing up. Basically, banks that have large mortgage portfolios, they lack sufficient reserves to cover their losses. One big bank called Bear Stearns actually goes bankrupt. Now, there was a feeling that maybe the U.S. government would step in to bail out Bear Stearns to try to solve it, but they decided, well, we need to let them fail as a message to the other banks to not take such big risks, that if you gamble with your money or other people's money and you lose, you should accept the consequences. And so we're going to let Bear Stearns collapse. Well, it didn't have the intended effect. In fact, what it did is cause the other banks to basically look around and say, we had no idea Bear Stearns had all these bad loans on its books. Which other banks also have, too many bad loans? And, which other banks are hiding their bad loans? And so banks are constantly engaged in lending money to one another in what are called short-term credit markets. And that's basically the lubricant that keeps the economy going. So now the banks are saying, I don't want to, lend money to any other bank, because I don't know how badly it's exposed to bad loans, and I don't know when it will, suddenly go bankrupt. So instead of loaning, banks just start hoarding cash. They quit lending to one another. They quit lending to homeowners. They quit lending. They're just holding on to their money and holding tight and hoping they can survive. And in fact, the existing loans out there, even to businesses that were doing fine, the banks start calling the loans because they need the cash. So they begin demanding that, let's say, the local, auto dealer that has money, has credit, that the local auto dealer, pay in their loans early. So or local, or big bit, even automobile manufacturers pay off your loan early so we can get the cash. Well, once that happens, then you have businesses who needed that credit to be able to make payroll, to pay their suppliers. If they can't make payroll, they have to start laying off people. If they can't pay their suppliers, then there's this kind of domino effect in the economy. And all of a sudden, Main Street starts hurting. And then finally, you have the stock market. The stock market crashed. Everybody, again, in times when things, when there's great uncertainty, people pull their money out of the stocks, they convert it into cash and hold on to it. So stock market falls. Now, this is what government's designed for, is to rescue an economy that's in free fall. So you have the Federal Reserve, which is like the nation's banker, so to speak. You have the Treasury Department, and they start bailing out distressed banks finally. And that included AIG, by the way. And they encourage others, banks that encourage healthy banks to buy up some of the weak banks to try to support them. The Fed lowers interest rates still further, starts pumping money out into the system. Congress provides funding for a systematic bank rescue. There's new assistance to homeowners, although, frankly, the banks and corporations got a lot more help than did homeowners directly. There's an economic stimulus package to employ people, re-employ people who have lost their jobs, so we start spending on infrastructure or schools or other things. The auto industry was about to collapse, and so GM and Chrysler get bailed out. And so finally, the economy hits bottom and starts to move back upward gradually. The banks start lending again, and the economy starts to recover. So in the wake of this, what kind of reforms were undertaken to ensure it didn't happen again? Well, each bank has a reserve requirement. It's kind of money that they hold on. They hold in a kind of it's like a savings account to cover rainy days, to cover bad times. So they were told they have to have a higher ratio of reserves to loans so that they could be ready if a lot of those loans went bad. They'd have enough money to make up for it. The government was given new authority to manage bankruptcies. There was greater regulation of certain types of risky investments. But a lot of the major options that were discussed at the time were rejected. One idea was that government should simply take over the banks and have basically a government-run financial system. That was rejected. Another idea was to break up the big banks. One of the rationales for bailing out banks is that they were so big that if they failed, then the whole financial system would collapse. So the idea was, if you break up the banks into a bunch of smaller banks, then if one of them runs into trouble, it's not big enough to threaten the whole system, and you could allow banks to fail without having to bail them out. Another idea, which had been in place with something called Glass-Steagall Act in the 1930s, was to separate investment banking from consumer banking. And the idea is that banks should not be able to use, funds from mom and pop businesses or from individuals to undertake risky types of investments. They should, they can manage wealthy people's money and take higher risks if they want, but that should be separated from consumer or commercial banking, where they would have stricter requirements. That law had been, in the late 90s, had been repealed. And so some people said we should reinstate Glass-Steagall Act. Another idea was to regulate bank compensation systems. Basically, that the bonuses that bankers and their staff were being given bonuses to undertake risks that were, unwise. So let's change the compensation system to encourage people to give them bonuses based upon undertaking only wise risks. Also, to replace the credit rating agencies with public agencies that would not suffer these conflicts of interest. And then finally, to basically a lot of this, a lot of the behavior that bankers engaged in was in fact illegal. So many people called for criminal prosecution of some of the top bankers. None of those options was carried out. Not even the prosecution of top bank executives. Some lower level bank executives were taken to court, but very few of those. So basically, the system was reformed at the margins, but not at its core. Now, the U.S. Financial crisis of 2008 was followed the next year by what was called the eurozone crisis, the European Union monetary system crisis. I'll only say a little bit about this, but basically governments there also bailed out private banks, and that left them saddled with some big debts. There were a southern tier of EU countries, Spain, Portugal, Italy, Greece, Cyprus, as well as Ireland and Iceland, that had not only had built up debt by bailing out banks, but they'd also ran big trade deficits with Germany in particular. And again, that left them with they had to borrow money from Germany to run those trade deficits. Now, in 2010, Greece revealed that a previous government, an outgoing government, had hidden the financial problems that it had on its books. So the previous government had basically put out false financial figures to make it look like Greece was solvent, that it had only debt, that it could manage its debts. The real figures were much worse and revealed that Greece had debts that it simply couldn't manage. And so then that led to worries about what about the other countries, the ones I mentioned, like Italy or Spain. Do they also have a worse financial situation that we don't know about? And so investors began to sell off the debt of those countries, and to basically bankers said, if you want to borrow from us, Greece or Spain or Italy, we're only going to lend to you if you're willing to pay very high levels interest rates in order to cover the riskiness of the loans that we're making. Of course, that made it even worse because those countries already were in financial difficulty. Paying higher interest would just make it worse. So these countries went to Germany, they went to the EU, they went to the International Monetary Fund, and they begged to be bailed out, either forgiven of some of their debt or allowed to borrow money at lower interest rates. And those EU, Germany, IMF basically said, we'll help you, but only if you agree to radically reduce government spending, to reduce wages, to undertake what are called austerity policies that would basically tighten the belt so these countries could free up enough resources to pay on their foreign debts. This meant that people's incomes went down, that unemployment went up, government social safety net went down, and as a result, politically, these were extremely difficult policies. And so ruling parties or coalitions in 10 out of 19 Eurozone countries actually fell. So what lessons? First lesson is that the global financial system's fragility is partly a result of its enormous complexity. And that complexity makes it difficult to know where the landmines are, where the risks are, where the vulnerabilities are. Part of this is because the financial system now has developed all these very complex and opaque financial instruments that nobody can understand. There's been a great rise in speculative and risk-taking kinds of investments. And the number of actors that have to coordinate in a global system, the international organizations like the IMF, the European Union, the national governments, which have multiple agencies, the big banks, the hedge funds, rating agencies, insurance companies, trying to coordinate their behaviors so as to avoid a crisis or to pull out of a crisis is extremely difficult. And the underlying problem is the global imbalances in trade that allow savings gluts to build up and leading to the flow of dollars into the U.S. economy to um, seek out returns that are um, more profitable, and that means riskier. More profitable almost always means riskier. Um, this is a little chart which you can study on your own. The PowerPoint for today's lecture is included under the Content tab. This shows you a little flow chart of how the financial crisis developed. So in the coming days, be looking at the stock market, be looking at interest rates, look at whether banks are coming under pressure, look at whether credit is freezing up or not. Those will be some indicators of how deep the current economic downturn will be. Well, not a very happy story, but I hope it's clarified some things for you. If you have questions, schedule a time to talk during my office hours or send me questions by email. Thanks. Bye-bye.